What's up everyone, Charlie here. We're going to go over some NSCC procedures which are involving short exemptions and what's called the limit risk monitoring tool that is provided by the NSCC. Now we're going to go over this because again, if you're like me, you like to learn financial markets and you like to learn how they operate, the procedures that underlie everything that goes on, and then you can make a determination on what is actually happening in the market. So it's always best to follow facts and documentation rather than word of mouth, especially in today's day and age when word of mouth spreads quickly and more quickly than ever before. So let's go ahead and take a look at some NSCC procedures. And the NSCC is the National Securities Clearing Corporation. They're a subsidiary of the DTCC, which is the parent organization backed by Seed & Co. Now let's go ahead and dig into this. So first of all, what is the NSCC? Well, the NSCC stands for, again, the National Securities Clearing Corporation, and it is a subsidiary of the DTCC, which is the Depository, Trust, and Clearing Corporation, that provides centralized clearing, risk management information, and settlement services to the financial industry. The NSCC offers multilateral netting so that brokers can offset buy and sell positions into a single payment obligation. And by doing this, this will reduce the financial exposure and capital requirements of NSCC. Now, NSCC has what's called a limit monitoring tool. And the text here says, NSCC provides its members with a risk management tool called DTCC Limit Monitoring, which enables members to monitor trading activity on an intraday basis of their organizations and/or their correspondent firms through review of post-trade data. DTCC Limit Monitoring was implemented in 2014 in connection with industry-wide efforts to develop tools and strategies to mitigate and address the risk associated with the increasingly complex, interconnected, and automated market technology. Such risks include, but are not limited to, trade input errors, software or trading algorithm errors, and inadequate controls for automated processes. Through this tool, NSCC members can monitor trading activity against limits that they have preset and can review notifications that are delivered when these preset limits are being approached and when they are reached. The limit monitoring tool is intended to supplement members' existing internal risk management processes. Any actions members determine to take in response to these alerts is their responsibility and is taken away from NSCC. DTCC limit monitoring is primarily discussed in NSCC Rule 54 and Procedure XVII. Now, a lot of the time I hear on social media that a lot of people get upset because things happen in the market. They interpret things as crime, as basically illegal things, but if you actually look into a lot of these procedures, most of what is happening in the market is legal. Now, the DTCC limit monitoring is available to all NSCC members. However, Rule 54 requires certain categories of members to register for the DTCC limit monitoring tool. This requirement applies to, number 1, any member that clears trades for others. Number 2, any member that submits transactions to NSCC trade capture system, either as a qualified special representative, otherwise known as a QSR, or a special representative pursuant to procedure IV, which is the special representative service. And 3, any member that has established a 9A or 9B relationship in order to allow another member, either a QSR or special representative, to submit locked-in trade data on its behalf. In addition, Procedure XVII requires, among other things, that members registered for DTCC limit monitoring create and establish risk entities, designate parameters to associate with each risk entity from certain parameter types that are established or permitted by NSCC from time to time, review reports and alerts on an ongoing basis, and, as necessary, modify established parameters to reflect current trading activities within each of their risk entities, and identify primary and secondary contracts within their firm for DTCC limit monitoring, or contacts, not contracts. So basically they're going to be identifying their primary and secondary contacts for that limit monitoring tool, which is supposed to help mitigate risk. Because remember, that's all that the NSCC is about, is risk mitigation. Now, this is actually coming off of a rule filing. We have a proposed rule, and this proposed rule is proposing to revise Rule 54 and Procedure XVII that we just went over to eliminate the requirement that certain specified members register for the tool. So remember, before they said that certain members have to register for it, but they're going to go ahead and eliminate that requirement here. And the tool that we're referring to is the limit tool that members clear trades for others, submit transactions in SEC's trade capture system through the QSR or special representative. Now, NSCC would also make conforming changes to procedure XVII to reflect that members may, but are not required to, create and establish risk entities, designate parameters to associate with each risk entity, review reports and alerts on an ongoing basis, and, as necessary, modify established parameters to reflect current trading activities within each of their risk entities, and identify primary and secondary contacts within their firm for the tool. So now that is no longer a requirement, it's optional. Now, NSCC would continue to offer the limit monitoring tool to all members on an optional basis, but would no longer require that any particular type of member register for the tool. So no longer requiring registration for this limit monitoring tool. Now, this is where a lot of you are probably going to take something away from this video, because this is involving CNS delivery exemptions. CNS stands for Continuous Net Settlement, and let's go ahead and go over this real quick. So Section D of Procedure VII describes the procedures for controlling deliveries to CNS, including the process by which members may submit instructions to NSCC to indicate which short positions they do not wish to settle and should be exempt from delivery. CNS provides for 2 levels of exemption. Level 1 exemptions allow a member to designate that portion of its short positions should not be automatically settled against its current designated depository position, or against any securities which may be received into its designated depository account as a result of other depository activity. Level 2 exemptions allow a member to designate that a portion of its short positions should not be automatically settled against its current depository position, but that such a position may be satisfied by certain types of qualified activity, and then they put in quotes, qualified activity, in its designated depository account. Section D.2, paragraph B of Procedure VII discusses the 4 types of qualified activity, which allow short positions carrying level 2 exemptions to be settled. The list of qualified activity currently includes, among other things, receipts from members, subaccount, which provides that as a result of CNS subaccounting, a member may have a long position in a given security in one CNS account and a short position in the same security in another CNS account, and since both CNS accounts settle against a single depository account, the member may receive securities from itself. So there you go. A lot of this stuff is legal, but they have the option. Again, there is a such thing called operational shorting. Now let's talk about another thing called fully paid for accounts. NSCC's processing day is divided into 2 parts. It begins with a night cycle on the evening preceding the settlement day for which the work is being processed, and is followed by a day cycle which ends on the settlement day for which the work is processed. Pursuant to Section E-5 of Procedure VII, if a member with a long position and or a position due for settlement on the next settlement day, in anticipation of receiving securities from the NSCC as a result of the allocation process during the night or day cycle for that settlement day, it instructs that securities within its possession or control be delivered on the next day and is subsequently not allocated the securities during the night or following day cycle. The member may, in order to meet the customer segregation requirements of Rule 15C 3-3 of the Exchange Act, during the day cycle for that settlement day, instruct NSCC to transfer the positions which have not been allocated to a special CNS subaccount known as the long free account. NSCC will then debit the member's settlement account for the value of the position in the long free account. So how about that? Now, a note from the SEC on this. Section E.5 of Procedure VII contains the following note related to the use of the long free account. The SEC has stated that any broker or dealer that takes advantage of proposed Rule NSCC-82-25 must recall deficits from bank loan within shorter time intervals than those presently allowed under Rule 15C 3-3, D1 of the Exchange Act. In the case of bank loan or broker-dealers who be expected to effect a recall within 1 business day instead of the 2 business days presently allowed. So again, they're all in cahoots, right? You make my life easier, we make your life easier. The SEC collects on their fraudulent charges, that's how they get paid, and then everything's legal. Now, the note refers to a no action letter issued by the Commission's Division of Trading and Markets, formerly the Division of Market Regulation, in connection with the adoption of Section E.5 of Procedure VII as a part of NSCC filing SR-NSCC-82-25. So that's basically what this one's about. Hopefully you learned something. And if you like learning about stuff like this or you enjoy videos on markets, I don't see a lot of people on YouTube covering filings, even after I did it all last year and the year before. So I'm going to get back into it and be covering some filings. I've built everything I've needed to in the Discord, which, by the way, if you're interested, we do have a 1-week free trial that you are able to come and sign up for free, no strings attached. You can try us out for a week. If you don't like what you see, you can leave. No strings attached. But we have the biggest Discord I've seen, and every single channel has a purpose. We have feeds, market feeds on market sectors, dark pools, golden sweeps, quant alerts, reg show, unusual options. We have real-time alerts with scalps, social spikes, stock breakouts. Basically, we're pulling in all of the services around the internet, putting them in one spot, and giving traders the tools they need to come up with a win, basically. And we've seen great success. But we're at that point now where we can start opening up a little bit more and adding in a little bit more people. So if you're interested, come check us out. Again, 1-week free trial with no strings attached. Everything you see here on the screen is in fact a channel that is bringing in data. We get about 28,000 or 30,000 messages per day from news to feeds and other stock market data. And basically what you're seeing is all the knowledge that I've been reading about and learning about, putting it to use in financial markets via the Discord. Thanks for watching, and I will see y'all next time.